We start today's market talk. There is a realization now that the conflict in the Middle East may continue longer than the markets can hold their nerve. And that realization is sinking in now. And that is why, after initial thought process that this conflict will go on for a week, maximum 4 5 days, now people are thinking that this is going to be endless or may not end too quickly. And that is what is getting priced in. So, and you can't go by what the news channels are telling and what the Trump statements are, because even US, they need a quick end to the conflict, but Iranians, in my opinion, have much to gain by prolonging the pain by drone strikes and attacks in the Gulf, which were totally unprepared for this kind of a conflict. And as we go through this presentation, I'll show you that first and foremost, inflation is going to hit uh, all of us everywhere in the world. Firstly, in terms of fuel prices, then in food through fertilizers and transportation costs, and which is leading to a serious bond market downturn. That is the only thing as I foresee, because earlier we had seen the same thing happening in April last year when the first time Trump went back on his tariffs, is that would force the US to pull back because of the bond market downturn, and not anybody, not anywhere else, because all the bond yields have started going up. So we everybody knows about how is the conflict going, who is doing what. So it's better to discuss how vulnerable is India's economy, because that is what affects us. The critical variables are only two for India, because we are not directly involved. How prolonged the disruption in energy supply is, and how sustained the price spike in energy resources and other things becomes. So if it is one-time disruption, it's okay. One-time spike, it's okay. But if it becomes sustained, like earlier the oil was at 60, if the new normal becomes 80, $90, then it has a different meaning altogether to the fiscal math of the government. Now, prolonged increase in crude prices could widen the current account deficit. Now, let me show you this. You see, this is a current account balance as percentage of GDP. So it was expected at around 70 to $75. It was 1% expectation of the current account deficit. At 100 to 105, it becomes 2%, and 120 to 125, it becomes 2.8% deficit. Now, current account deficit occurs when the total value of goods, services, and transfers a country imports exceeds the value of those in exports. It is a key component of balance of payments and serves as a barometer for nations' external competitiveness. So it is basically, it moment you have a current account uh, balance. So if this is becomes 3%, that means you are actually exporting growth. So your growth reduces, and somebody else, because you're importing stuff, so somebody else is having more growth, and you are basically giving your growth to somebody else. So now rising current account deficit will put pressure on the rupee amid a continued risk of negative global sentiment and continued selling by FPIs in Indian equity markets. So predictably, the rupee has made a fresh low of around now 92.5, and this is also leading to FI's exit, and this also needs to stabilize. And this is despite the RBI's interventions. If there was no RBI intervention, this would have fallen a little bit more. So that is the second problem. Uh, Higher crude prices could also feed into domestic inflation. Uh, it has because now we have come to a new series on inflation. It would have, and that has higher percentage of crude in it as compared to earlier. It will have a larger impact on WPI than CPI. So the point is, fiscal, as I was mentioning about fiscal deficit, it will go to around 4.6 to 4.8%. Retail inflation could go to 5% plus, and then the growth will come down. So actually, overall, the nominal GDP growth will be higher. It will become 12 to 13. So that I'll cover later as to what is the impact. But uh, if inflation is higher, then the real GDP growth slows down. Uh, so there is a downward risk to FY27 growth, which will have an impact on investment, inflation, and external trade. So, if you see here, uh, government fiscal math could also come under pressure. Higher crude prices may raise the fertilizer subsidy bill, squeeze corporate margins and tax collections, and reduce dividend payouts from PSUs, particularly OMCs. Now, in case the oil prices, OMCs are not allowed to raise oil prices, then they have to take the hit in terms of their margins. So, all the profits they are having just evaporate. And so, the government's earnings from the dividend which these PSUs pay also reduces. So as I have brought out, there is a downside risk to FY27 GDP growth. Now the next action is that industrial production will take a hit. So disruption of LNG, LPG imports has created a dual fuel physical shortage, necessitating immediate intervention by the government. Objective is to shield domestic household consumer and critical urban transport infra. So what happens is both the industrial and service sectors are staring at job loss with significant ramifications on consumption, because that is the second order or third order effect. So now what happens is the supply of LPG and PNG has been reduced. So domestic supply has been maintained. Tea industries, manufacturing and other industrials, it has been 20% reduction. Fertilizer plants, 30% reduction. And refineries and petrochemical units, 35% reduction. So what happens is your import bill goes up and the corporate production goes down. So now sectors impacted by gas shortage, fertilizers. So urea output squeeze, so you will have to import fertilizers. Restaurants, QSR, food delivery, commercial LPG cut, threatening closures, gas importers and distributors, all these GAIL, Petronet, LNGs, etc. They would be having a disruption in their supply. Tile makers, businesses closed because gas is 70% of their fuel cost. Auto ancillaries, it can increase fuel cost for consumers, affect vehicle demand, and also raise input costs. So that's why you see the auto sector is the biggest sector which has got hit. Consumer durables, fridges, AC makers hit as LPG, a key raw material, gets rationed, and that is what the remark which has come, or the update which has come from PG Electroplast. Glass makers, furnaces running on costlier backup fuels after force majeure on gas contracts, and that is why that is a update which has been given by Borosil. Metals, these small steel plants cutting will cut output or shut down entirely because they require energy. Chemicals, ammonia, methanol, acids facing input cost spikes due to gas feedstock dependency. So if you summarize, agriculture will face a surge in inflation due to import of fertilizers. Industry, SME, steel manufacturing segments will face production cuts, workforce layoffs, and factory closures. Now, workforce layoffs and factory closures will affect overall consumption in the economy. Steel shortage will affect construction, real estate, infrastructures, delay project completions. Ceramic, glass manufacturing, and petrochemical complexes face administrative supply curtailments. Contraction in gross value added GVA will drag the economic growth. Commercial LPG deficit compresses operating margins across hospitality, catering and retail food sectors. QSRs and food delivery platforms face severe operational bottlenecks and margin pressures. The biggest problem is economy faces a stagflationary paradox. Now, stagflation is that if in case the inflation is higher and your growth is lower than the inflation, you can't cut rates to promote growth, because that will lead to higher inflation. So moment you get into a stagflation paradox, the corporate earnings cannot go up because they can't raise prices. Prices cannot be raised because consumers will not be able to pay for it, because their earnings are also lower. So that is the issue. Now, predictably, India VIX has gone up. You see, Last year, it went up due to Trump's tariff, and then these levels 22, 23, it went up because of this was a conflict with Pakistan, and now it is back up. It was correcting, it had come down, and then again it has gone up to 22, 23 level, and this is the best indicator of what is the sentiment in terms of markets. Now, coming to FIDI data, it is amazing right now. It's the strongest FI short positions in index futures. They have and they sold massively Nifty on Friday. They are short on calls and bought puts in index options. They have sold in cash strongly. They are strongly bearish. Pros, they have bought in index futures. They have sold calls and bought puts in index options. So they are mildly bearish. And clients are, if you see, bought index futures, bought calls, and sold puts in index options. So they are strongly bullish. Hence, what we are seeing now is a market which is at extreme positioning. Means FIs are extremely short and clients are extremely long. So one thing will happen, moment any direction the market moves, it will be a big decisive move. So be prepared for it. And if you see, FIs have, I'll show you in the next slide. FIs have sold, if you see from 26 February onwards, they have sold roughly 65,000 crore net cash since 26 Feb. So that is another problem, cash selling, which is leading the markets down. And on the days they sell in index futures, FI index futures they sell, and they sell in calls and buy puts. The market also goes down, and they did massive index futures shorting and option shorting on Friday, and the market went up 2%, down 2%. So this is what the positioning is. Now coming to US markets, so if you see here, the most interesting thing is that the bond yields have started going up. And if the bond markets collapses from below 4, in 1 week it has gone to 4.28. And last time, if you see, in April this spike took place, and that led to Trump delaying the tariffs. So this was the spike which had led to Trump delaying the tariffs when everybody started selling the US bonds. So this is the problem, and this is what can actually bring a stoppage to the war and nothing else. Now dollar index has again started going up. It's a safe haven. It will pressurize gold and emerging market currencies. Brent crude, it went up to 120, came down, but now it is above 100 at 103. So firmly above $100 level. Risk premium is expanding. So we'll have to watch this. Gold has corrected. I think it is also correcting because of dollar strength. People are selling gold, booking profits as they need money, etc. Or people will sell whatever they have profits in and moving into dollar or US bonds, which are safer. So this is the reason why the gold is correcting. But in my opinion, if it comes to around $4,600, that should be a good opportunity to buy. Also, it is correcting because central banks may not be buying right now because they have better other things to do as to protect their currencies, etc. as the dollar is going up. Silver again is also correcting. Again, similar reason. People are sitting on profit, so they will book profits. Copper off from highs, but demand from data centers, etc. should provide a base. So we may correct a little bit more, but not much. Bitcoin showing resilience, but upside cap due to liquidity drain caused by surging dollar. All the US indices are now at the lowest level in 2026. So they are correcting now, and they have become negative for 2026. Similarly, S&P 500, it has come down, and Dow Jones also has come down, right? Dow Jones is also correcting because there is a private credit problem in the US. So there are multiple reasons for them to also Correct. I will speak about private credit issue also slightly later. But it's a big problem. So rising bond yields and the collapse of the private credit market are two of the bigger problems which nobody is talking about right now because people are focused on Iran right now. Now coming to Nifty, so if you remember last week I showed you this is the rising trend line from COVID lows. It was tested in April when the Trump had announced tariffs, and then it recovered, and now this has been broken. So the trend is down. Now, if you see the Fibonacci retracement, uh, see this is a complete rise from the April lows to the top, and now it has breached the 61% retracement level. So, firstly, this 23,500 would be the first would be the resistance. The next support should be somewhere around 22,700, which is the 78.6% level. But if it has retraced 61%, that means the move down is most likely. So generally after 61% retracement, it goes down fully. So 21,800 is the most likely target of this fall. Then you may see some rise. It may go to 23,500 odd, and that is the time to short. So right now the markets are oversold. So if you see here on the weekly charts, RSI is around 30.43. So it is oversold right now. On the daily charts, if you see on Nifty, it is oversold now. It is 24. So it has to rise a bit. But if you see the ferocity of the fall, the possible Fibonacci extension targets. So if you see here, the immediate target should be around 22,000, right? And next target should be around 21,400 odd. And otherwise, this was the support that is 21,800. So if so this should be the likely target. So in case the market collapses from 23,000 or it opens gap down on Monday below 23,000, then you will quickly in next week in 2 days go to 22,000 because they are falling around 300 to 500 points every day. So at this pace, we'll go very quickly to these levels. So be careful. Nifty Bank. So if you see here, it saw 7% odd decline. So it was the weakest component. Indicates aggressive unwinding and positions and heightened risk aversions. So there is big unwinding because this was the leading sector. So now what has happened is if you draw this channel on the weekly charts, it is at the bottom end of this of the rising trend line. So if this breaches, then it will go down very quickly. And if you see here, this is the first support. It has come down to the support now. This was the point from which the rally started. So if you see here, this 53,500 is the first support. And if this breaks, then you're seeing 48,000. Because people are booking because of there is a business risk to the banks and there is a risk to the economy. So these are, this is going down. So I personally feel that markets may need some more time before finding a meaningful bottom because there is first the decline has to stop. You don't go against or you don't catch a falling knife. Let it fall first. Let it lie down flat, and then market may indicate some pullback or some rally, etc. But right now there is no change to the trend right now. Trend is down. The autos is the biggest fall. Saw the biggest fall last week, around 10% plus. Weakest segment. Don't try to bottom fish here. It can go down further because if the whole economic factor or the economy theory is in a doubt, so the biggest consumption thing is auto only in India. And in case the consumption is going to decline, then the biggest fall will be seen in autos. HDFC Bank is somewhere close to the support, but in this kind of a market, and it is oversold, but it can fall anytime more also. So it should find some support at these levels, but it can always go down to the 700 odd levels also in case there is a FI selling, and these are going down because of FI selling. Reliance has been stable. It has held these levels. So let's see and it bounced from the 200 EMA. So 1310 should be a decent level for Reliance. Now, the last week, as I was telling last about L&T, there's a there is if you see last quarter also in L&T, the earnings were not good. The stock went up because of good order book. Now the order book is in doubt, and that's why it is selling off, and it is selling off with large volumes. So be careful with L&T. It can go down to these 3,100, 3,150 levels, where hopefully it should take some rest or something like that. But we'll have to see that, because it's oversold on the daily charts. But any bounce up to 3,600, it can go up, and then it will get shorted again. So be careful, and don't see that if from here it has bounced, so that means that it's a trend is changing, etc. Because there is a business risk to their future earnings and all those issues. First, the war has to stop, then they will get orders. Midcaps have also corrected around 4%. Now it is below the high, so it can easily go down more from here. Similarly, small caps, they are also on the around 4% fall last week. So, in summary, what I will say is, look at crude prices very carefully. Though, as I had mentioned, that crude prices may be also manipulated, so they may not be a direct, like even last week you saw on Monday it went to 120, and then it came down very quickly because it was being controlled. So there would be some distraction at higher levels, so the demand will reduce. So as I was mentioning, to reduce the demand, the prices have to be increased at the pump, otherwise the demand will not reduce. And the fiscal deficit and the problem in the balance sheets of the oil marketing companies will keep going down, going bad to worse. As we have seen, the economic impact or the stock market impact has been maximum in India, because longer it will continue, it will be a problem for India. So till the time we don't know when the conflict is going to finish, you cannot go long on India right now. You have to be shorting India, and that is what everybody is doing, because we are very dependent on imported energy. Now, how we can get out of it, the US has to stop. What will make the US stop is, first is case they start feeling that they may lose the elections, the midterm, so they may just walk away. So political considerations may force the US to stop the war at some point. So one should be prepared for that. But if case it comes, there would be a big short covering. So don't be on the short side at that time. Now, what happened last week was that multiple nations released SPR. So they had released SPR worth around I think 20 days of requirement. But that led to rise in crude prices, because then the market took it that means there is actually a problem. Hence, they are releasing such large quantum of SPR. The biggest beneficiary is obviously Russia, because now they are not giving any discounted crude to anybody, and China also, because they had adequate amount of strategic reserves. So they are okay. They will manage. Problem was that the attack on the GCC countries was not anticipated, and that has led to poor sentiment, and that has led to collapse of other issues like force majeures in a lot of gas producers like Qatar, etc. And that is what is leading to problems. And a lot of Indian companies who get contracts in the US also are affected. As I have mentioned about current account deficit, that is the problem, and that is leading to decline in the rupee. In addition, the savior used to be the IT earnings, which used to cover our deficit in terms of trade with China and crude, etc. And we were getting discounted Russian oil. So now that is also under doubt, and that's why the rupee is reflecting the pain. As we have mentioned about the energy issue, so the growth, as I have shown, the GDP growth will get compromised. So that is a problem. As I have shown you, gold in this situation is not a hedge, because the prices were already up. So now people are selling it to book some profits, or people are selling wherever they have profits. I have spoken about stagflation. We are heading into a stagflation where the inflation also remains higher and the growth is lower. So to boost growth, the central bank oblique RBI cannot lower rates because that will lead to higher inflation. So right now, if you get into a stagflation scenario where inflation goes to 6-7% and growth is also 6-7%, then it will create a problem. So you have to be cautious right now. Though, as I have mentioned, because of our problem in the last year or so was that the nominal GDP growth was below 10%. So people are saying corporate earnings will not be there. So that should be good, but we'll have to see whether how much of price increases the corporates can pass to the companies, or corporates can pass to the consumers. Because if input prices are not passed to the consumers, corporate profits would decline. So one has to see, because in stagflation scenario, there is a problem to corporate profits. I had shown you US bond markets are in trouble because the bond yields are going up, and this is the only thing which will put pressure on the US because they have to recycle their bonds. So at higher prices, they would not be able to recycle their bonds. So all this problem of tariffs, etc., was to generate more revenue. So that is the problem. And I had spoken about private credit. Private credit is basically when you see there are a lot of companies in India also where you can borrow from them for 10-12% without any security, etc. And you can, and that market in the US is impacted because certain big companies have stopped redemptions. Moment one person stopped redemption, others started asking for redemptions, and now they are cutting down on redemptions because there is a problem of liquidity, etc. So that is the reason why the US financial markets are in trouble, and that is another problem. Okay, so I'll cover two stocks. First is KSH International, leading supplier of transformer conductors to Indian and global majors. It is doubling capacity to 59 kiloton to meet the increase in demand. Estimate volume, EBITDA, earnings growth is 24%, 36%, 43% over FY 25-28. Approvals for high voltage is generally a long drawn process. It is qualified to supply winding wires for higher voltage and HVDC transformers. So like people are going after transformers or the HVDC guys, these are the guys who are providing them wires for the transformers. It also sells round wires to industrials, appliances, and automotive industries, contributes 25% of the revenue. In light of India's transmission capex outlook, transformer companies are growing their capacities as well. Gross profit per ton has steadily been rising since FY23 due to increased demand for winding wires. It exports a significant percentage of its overall exports to the US and Middle East. Now that is a issue because exports will be impacted right now. Its debtor days remain elevated. That is most important, reflecting longer credit terms offered to customers where billing is often milestone based and collections are slower. And their payable days, I'll show you later, are still lower, but their collection days are higher. So basically, this was transformers construction. There are primary coil, secondary coil, and core. The core and winding of a transformer are the most important parts. High voltage transformers use CTC and PICC conductors. CTC is continuously transposed conductor. These are required for large transformers, and PICC is paper insulated copper conductor. These are required for lower voltage transformers. CTC market is characterized by higher manufacturing complexity and higher barriers to entry. It has KSH has a lot of these clients: Hitachi, transformers and rectifiers, Siemens, other Toshiba, etc. They are their Voltam, etc. are their clients. They are trying to increase their capacity now. For CTC and PICC capacity, they are trying to, from 19 kiloton, they are trying to increase to 32 kiloton. See, India's transformer manufacturing are tripling their capacity. So all of them are, because of the transmission upgrade to transmission infrastructure. So all Hitachi, Siemens, CG Power, Terrell, Atlanta, etc. are increasing their capacity. So their requirement will be met by these people. In the specialized wires, primarily CTC, PICC, there is competition. KSH International is one, then APAR, all of them are trying to expand capacity. Then Precision Wires, again the same, and a smaller company called Esta. So all of them are trying to expand capacity for this reason. Expect around 24% volume CAGR over the next 3 years. Gross profit to normalize. So gross profit per ton are now rising and now should normalize once they have done their capex and paid off their debt from IPO money. Revenue CAGR of around 33%, gross profit CAGR of 32%. Profit should see around 200 crores by FY28. So they're rising nicely. Growth is around 30 to 40% over the next 2 years. So 200 crore profit. It's at right now around 2630 crore market cap. So if you see FY28 earnings, it's at roughly around 13 times. So it's not very expensive stock. Debt to reduce drastically due to fundraising via IPO. So what they have done is they have raised their net worth and reduced their short-term and long-term debt to pay for their pay from their IPO money. So if you see here, the net sales are expected to grow, as I showed you, around 25 to 30% over the next 2 years. So they should do around 3,839 crore of net sales. EBITDA margins are around 6.3, 6.7. It's a lower margin business. 153 crore profit in FY27 and 200 crore in FY28. So it's around 13 times. EPS, they should do around 22 in FY27 and around 30 or 29.9 in FY28. Taking a mean of around 25, 26, it should be okay. So this stock is at around 370, 380 right now. So it is not very expensive right now, 12, 13, because it is pricing. It's a recently listed company. Strong EPS growth. EV EBITDA is also low. So below 10 is decent. ROE is good. The problem is here. Receivable days are at 4. They're trying to bring it down at 42 and payable days are 7 because they have to pay for all the requirements of copper, etc. very quickly. So payable days are low and receivable days are high, and this is the basic problem with this company. So they would get into a short-term debt problem. Now this stock listed somewhere close to the IPO price and has been flat. It went up to around 420 and now this is a daily chart. So it corrected around 6 odd % on Friday. So if it comes to around 350, 360 levels or 370 levels, this should be a decent opportunity to buy this stock. And as if you see the PE wise, it is much cheaper to APAR and Precision Wires, etc., but at a smaller scale. So just keep this in horizon. Other stock is Dixon Technologies. Union Cabinet has approved changes to Press Note 3 framework for FDI. Dixon has received approval for its HKC joint venture to manufacture display modules of a double-digit EBITDA, and M is basically management fees. After management fees, this raises level of backward integration to smartphones by 10 to 12% from 16 to 17% now. So their backward integration in smartphones is going up, so their margin should go up. Improve the odds for PN3 approval coming for Vivo JV also. So that HKC JV is through. Now they need approval for Vivo JV. All are these Chinese companies. So they are thinking that with the change in the government stance with respect to FDI from China, so these should go through. It has already received approval for its JV with QTech for camera modules. Bill of material around 8 to 9%. So that is the quantum of stuff they are putting. It targets achieving 40 to 45% backward integration by display modules, camera modules. Operating margins, excluding other income, are at around 3.88%, reflecting high volume, low margin nature of contract manufacturing. So the key issue is the volumes have to keep increasing, the revenues have to keep increasing. Otherwise, the operating leverage starts working other way around. Global spike in DRAM prices. DRAM is dynamic random access memory driven by AI and data center demand, has significantly increased the bill of materials for smartphones. So rising costs are crushing demand for budget smartphones, particularly for clients like Xiaomi and iSmartU, which is Dixon's core volume driver. So in case the smartphone prices go up, will the demand sustain is a core problem. Plus all these problems with their JVs with the Chinese company, and there is ongoing concern regarding extension of the mobile PLI. Now, if you see here, in the last quarter, they just did 2% of revenue growth. Operating profit, and this is adjusted. So operating profit was up 6%, and PAT was up 5%, right? For the whole year, PAT is up 26% and revenue is up 34%. So there is a slowdown, and that is being reflected in the price. So if you see here, estimate wise, they are expected to, with Vivo GB not built in still, JV not built in, they are expected to do around 64 million units, that is 6.4 crore units in FY28 and 5.3 crore units. So they are increasing around 30% growth is expected with all their clients overall. So see, they have Oppo, Vivo, OnePlus, Realme, Nokia, Intel, Techno, Infinix, Motorola, Xiaomi, Compel, Google, Samsung, some new ODM exports, etc. So they have huge opportunity in this field. Now, if you see here, smartphones volume growth is expected around 30% plus in FY27 and around 20% in FY28. So CAGR is around 28% growth. Consolidated revenue growth should be around 40% plus in FY27. That is expected, and the CAGR of around 30 odd percent. Margins are remaining at this 3.8, but in case they do a lot of backward integration, it may go to 4.5. But margin, volume growth and the revenue growth is very important. So they are expected to do a EPS CAGR of 50% over the next 3 years. From 140 odd, it is expected to go to 360 and 229, taking a mean of around 300 also. Right now, they are at around 35 times. So not very expensive, but the market is praying for the growth. Now, they clock in best EPS CAGR, which is expected actually, and return ratio. So if you see return ratios among Amber, Sirma, Keynes, and PG Electroplast, they are the best. So that means their profit percentage should be higher. So that has to be kept in mind. But so if you see here, among them again, considering their P's, etc., even things like Sirma, SGS, and their EPS growth, which is expected, becomes pretty attractive. So watch out for this EMS space. So now they are expected to do, as I told you, around 40% revenue in FY27, EBIT growth of around 45%. So for FY28 earnings, which I'm still not 100% sure about, they are at 30 times. So taking a mean, they are at around 35 times right now. So if you see the stock, it has corrected from that 18,000 levels. Every time it goes to that 19,000 level and comes down. So first it came down to around 12,000 and then went up to 18,000 and then has come down to 10,000 level. So if you see very clearly, it is making lower highs and lower lows. So the point is that I would wait for this quarter earnings. And in this downturn, in case I get a good price somewhere around 9,000 odd, then maybe entry can be taken. Otherwise, this is going down, and I'll wait for this quarter earnings to see what is the trend. Is their earning growth and all their JVs, etc., come down? So this is it. I have finished. We'll take questions now. Yeah.